Hello everyone, I am Michelle. Welcome to this channel and thanks for joining me here. Before I start, please feel free to subscribe to this channel and switch on the notification button so that you will receive the e-learning videos seamlessly from us. Today, we shift our risk focus from the immediacy of liquidity to the pervasive and strategic challenge of interest rate risk. We will explore the critical role of auditing the frameworks that protect an institution's earnings and economic value from the volatility of interest rates. Whether you're in a bank, a fund, or any entity with a balance sheet, this is fundamental. Our path is clear. We'll begin by defining interest rate risk in its various forms. We'll then discuss why managing and auditing IRR is more crucial than ever in today's economic climate. Next, we'll dissect the core components of an effective IRRM framework. This leads us to the audit core, our objectives, key risk areas, and testing procedures. We'll examine typical findings and red flags and conclude with actionable takeaways for enhancing your audit approach. Let's define our subject. Interest rate risk is the risk to current or future earnings and capital arising from adverse movements in interest rates. It's not a monolith, it manifests in several key ways. 1. Repricing risk, the most common form. Mismatches between when assets and liabilities reprice. If rates rise and your liabilities reprice faster than your assets, your margin gets squeezed. 2. Basis risk, when the rates of different interest-bearing instruments fail to move in perfect correlation. Think of loans tied to prime versus funding tied to secured overnight financing rate, SOFR. 3. Yield curve risk, a flattening, steepening, or inversion of the yield curve that impacts the value of positions differently across maturities. And 4. Optionality risk, the risk from embedded options like prepayments on mortgages or early withdrawals from deposits, which change behavior with rate moves. Our audit must consider all these dimensions. Why is this audit so vital? 3 converging reasons. First, direct financial impact. IRR directly hits the net interest income, NII, the lifeblood of many institutions, and the economic value of equity, EVE, a longer-term measure of solvency. Get this wrong and you impact profitability and valuation. Second, a volatile and unpredictable environment. With central banks moving rapidly after a long period of stability, traditional assumptions have been upended. Our audit must challenge models built for a low-rate world. Third, heightened regulatory expectations. From the Basel Committee's principles to specific guidance from the OCC, Fed, and others, regulators demand robust, forward-looking IRR management. Our audit provides the critical, independent assurance to the board and regulators that this is in place. To audit effectively, we must evaluate the entire framework. It rests on 4 interdependent pillars. Pillar 1, governance and strategy, the foundation, a board-approved risk appetite statement for IRR, clear ALCO oversight, and comprehensive policies. Pillar 2, measurement and models, the analytical engine. This includes gap analysis, simulation models for net interest income under various rate shocks, and economic value of equity calculations. Pillar 3, limits monitoring and reporting, the control system, translating risk appetite into concrete limits on gaps, NII at risk, and EVE sensitivity with clear escalation procedures. Pillar 4, hedging strategies and controls. The active defense, policies governing the use of derivatives like swaps or options to mitigate risk, with independent validation of their effectiveness and accounting. Now, to our audit, the core objective is to assess whether the IRRM framework is accurate, effective, and compliant, ensuring risks are properly identified, measured, monitored, and controlled within appetite. Our scope is wide. We examine governance documents, the integrity of data feeding models, the assumptions within those models, limit monitoring reports, the effectiveness of hedging activities, and the quality of management reporting. We interview traders, treasury, risk managers, and model validation teams. First key area, governance. This sets the tone. We will inspect ALCO minutes. Is IRR a standing substantive item? Are limit breaches analysed, not just noted? Is the risk appetite statement quantitative and understood? We will reperform the linkage. Can we trace a board-level EVE shock limit down to a specific trading desk's notional limit on swap positions? We will interview senior management to assess their grasp of the institution's key rate exposures and the strategic use of hedging. Area 2, models and assumptions. This is often the most technical and critical area. Garbage in, garbage out. We will review the independent model validation report. Have the NII and EVE models been validated recently? What were the key findings and were they remediated? We will challenge core behavioral assumptions. Prepayment rates on mortgages, decay rates on non-maturity deposits, like checking accounts, and the treatment of embedded options. Are they based on recent relevant data, especially from a rising rate period? This is where many models broke down in 2022 to 2023. Area 3, data and controls. We will select a sample of instruments, loans, deposits, derivatives, and trace their key data, repricing date, index, optionality, from the source system through to the risk measurement reports. Is data mapping accurate? We will recalculate risk metrics for a sample. Does the reported 200 basis point parallel shock to NII match our independent calculation based on the same data? We will analyse limit breach reports. Are they timely? Are corrective actions documented and effective? Final key area, hedging. If the institution uses derivatives, we must audit them. We will test the effectiveness of hedging relationships designated under accounting standards. Is the documentation robust at inception? We will evaluate the hedging strategy. Does it align with the risk appetite? Is there clear separation between risk mitigation and speculative activity? We will reperform a sample of end-of-day marks for derivatives and verify collateral management processes. This links directly to operational and counterparty risk. So, what do we commonly find? Let's highlight pitfalls. Finding 1. Black box models. A lack of understanding by management of the models they rely on. Over-reliance on vendor models without customizing key assumptions. Finding 2. Stale assumptions. Using pre-2022 behavioral assumptions for deposits and prepayments in a post-2022 world, leading to a severe underestimation of risk. Finding 3. Siloed. Hedging. The derivatives desk operates without tight integration with the overall IRR strategy, creating basis risk or even amplifying exposures. Finding 4. Inadequate shock scenarios, relying only on standard plus or minus 200 basis point shocks when the real vulnerability might be in a non-parallel shift or a basis spread widening. These are the red flags that signal potential control failures. In conclusion, auditing IRR management is not just about checking model math. It is a strategic assessment of financial resilience. Our role is to move from asking, is the report produced, to do the reports reflect reality and inform decision-making? We must ensure the framework is dynamic, assumptions are alive, and strategies are effective. In a world where interest rates are a primary driver of value, a robust IRR audit is a direct contribution to the institution's strategic stability and long-term performance. Your key takeaways today. 1. IRR is multifaceted. Audit must cover repricing, basis, curve, and optionality risks. 2. The heart of the audit is in the assumptions. Challenge behavioral models and stress scenarios rigorously. 3. Connect the dots. Governance must link to limits, data must feed accurate models, and hedging must align with strategy. A forward-looking IRR audit doesn't just find past errors, it fortifies the institution against future rate shocks. That concludes my presentation. Thank you for your attention and time. If you found this channel is useful, please feel free to subscribe and share it with your friends and colleagues. Thank you for your support and have a great day.